Yo, what's going on, guys? Welcome back to the channel. Today we have a special episode. A lot of you guys have been asking me, how does strong credit look? How do I build it? Today we're going to be breaking that down at what a strong credit profile looks like. That way you guys have the foundation. When you have the foundation in place, you can go to any bank and get an approval. So today we're going to be breaking down each section, what it means and how you can optimize it. For those of you guys that are new to the channel, make sure to hit the subscribe button. That way you are notified anytime I post a new video. For you guys that are returning to the channel, welcome back, family. Happy to have you guys here. And as always, if you guys are not following me yet on Instagram, go ahead and follow me there. It's at Alex Credit Expert. I post on a daily basis and I'm very interactive, asking you guys questions. That way we can get to know each other a little bit, and who knows, I might be answering one of your questions one of these days. So guys, with that being said, let's get straight to the video. Let's get through that information. So this is what a strong credit profile looks like. The first thing we need to talk about is going to be payment history. So payment history pretty much is how have you paid other lenders back. You want to make sure you have 100% payment history. That means you never want to miss a payment. How can we make sure that we set ourselves up for success? Well, whenever you guys are taking out credit cards or loans, you want to make sure you instantly set up auto pay. Let's write that down. Auto pay. What auto pay is basically saying that the bank is going to withdraw this money on the selected date every single month. This way, you're able to make sure that if for some reason something happens, maybe you forget your phone, maybe you break your phone, maybe you go out of the country, at least you have some form of payment set up on auto pay so the bank can automatically withdraw it. Now, you just want to make sure when you are setting up auto pay, you want to make sure that there's actual funds in the bank account, because even if you set up something on auto pay and there's no money, nothing's going to happen. You're still going to get a late payment. So guys, the biggest and easiest thing to do once you set up your credit cards or your loans, whatever you just got, set up auto pay. This is like extra insurance. I still recommend though that you manually check these credit accounts, because you don't ever want to be in a position where auto pay missed, maybe it misfired, or maybe you try to withdraw the money but you didn't have the money and you forgot about that, so then the auto pay didn't work and then you miss a payment. So auto pay is more of like an insurance policy on your payments, kind of call it that way, think of it that way. But remember, you still want to manually check all the time. Just have auto pay set up as an extra form of precaution. Now, if you do not have 100% payment history, maybe you've already been late sometime in the past, what we need to do is ideally remove those late payments. So the way we're going to do it is two ways. What you can do is whatever lender you're currently late with, you can call them and ask to see if there's any way to update the late payment to paid on time. A lot of times, just being straight up with you, they're going to say no, but it's worth a shot. You could tell them something like a sad story, or you can see if you can work a deal. Maybe you can tell them, hey, I can pay you an extra X amount in order for you guys to reverse it. Just try talking with them and seeing if there's anything you guys can do. Also, you can send in what's called a goodwill letter. That's pretty much you explaining your story on why you got this late payment in the first place and why they should update it to paid on time. Sometimes that works, but again, a lot of times when you do have a late payment, it's going to be very tough for them to automatically update it. So in this situation, I would recommend some type of credit repair. See if there's a credit repair specialist that can help you with that situation. Now, moving forward, now that we've covered payment history, the next most important thing is going to be credit utilization. So what is credit utilization? This is how much are we using out of our available credit card or our credit line. I'm gonna give you guys an example. If you have a $100 credit card and you use $30, you have used 30% of your credit card. So right now you would be at 30% utilization. Following this rule, we do not want to go past that. Now, I want to make it very, very clear. Credit utilization only matters when your credit card updates. All of your credit cards update on a statement closing date. Let's repeat that. A statement closing date. So what this means is, usually you'll have a statement opening date and a statement closing date. Most credit cards are going to be a 30-day cycle. So let's just say on the 1st of the month, your statement opens, and on the 30th of each month, your statement closes. What that means is you can spend freely as you would like throughout this time. You just have to be aware whatever balance is remaining on the 30th when your statement closes, that'll be reported to the credit bureaus. So imagine, let's say you have a $100 credit card. Let's say you spend the full $100 week 1. Next week, you pay it back. Week 3, you spend $100 again. And then week 4, you pay it back. As long as you pay this thing down before the statement closing date comes, whatever balance you leave on this date is going to report. So let's say you max this card out 6 times. Let's say you spent 100, paid it, spent 100, paid it. You did that 6 times, right? I'm not saying that you can only use 30% of your credit card. You can max that out as many times as you like during this billing cycle. You just need to be aware of when your statement closing date is, because when this date comes, whatever balance you leave is going to reflect. So let's say you don't understand statement closing dates and you don't understand credit utilization. Let's say you max out your card, you're paying it, maxing it, paying it, maxing it. Well, if you paid it off, but then you max it out before the closing date, maybe what happens is you leave a $100 balance, and now this reports to the credit bureaus, and then now you show 100% utilization. But since you follow me and listen to me, you now figured out that there's something called a statement closing date. Now what you're doing is, even though you're maxing out your card or spending a lot of it, before this date comes, you're paying off your card entirely. So even though you could be the same person as this person, you have the $100, but you pay it off, now, when the statement closes, you're at 0% utilization. So this can be a little bit of a confusing topic if you don't already understand it, but I'm doing my best to break it down. And in so many videos, I keep breaking it down. Eventually, you guys will get this. But just check your credit cards. Every credit card has a statement. You'll see it usually in the top left corner or the top right corner. It says billing cycle or statement opening date and statement closing date. Just remember, on the closing date, whatever amount of balance you leave, whatever you owe on the credit card, whatever is showing, that is what's going to report to the credit bureaus. And from there, your credit utilization will be calculated. A very easy way to make this make sense, most of the time with your credit cards, you will have your minimum payment due date. This is when the credit card company is telling you, hey, pay us this bare minimum to keep this account in good standing. Usually 3 to 5 days after is when your statement reporting date closes. So that's an easy way for you to know when your closing date is. If the banks typically ask you for a minimum payment on the 3rd, I would say most likely your statement is closing around the 6th or 8th of every single month. And remember, these dates are usually always going to be the same every single month. If your minimum payment is always on the 3rd, it's usually always going to be on the 3rd of the month. If your statement closing date is on the 8th, it's usually always going to be on the 8th of the month. The only time this stuff can change is when we have short months. For example, February. If your statement closing date is usually on the 30th of each month, on February, it might be on the 28th because it doesn't run up to the 30th. So that's the only time to be looking out for that, but that's, side note, not really too relevant. But again, guys, pay attention to credit utilization. The reason this is so important is because if we are showing maxed out credit cards, when we apply for more credit cards, the banks are going to deny us because they're always looking at how we're handling our credit. If we don't time our stuff right, then what's going to happen is we're going to apply for funding when we're maxed out, and the banks are going to deny us because they're going to say, hey, you can't even handle the money you have right now. Why would I give you money? But if we understand credit utilization, this is when we pay our stuff down, and we're referring only to credit lines, credit cards, lines of credit. We pay our stuff down under 30% utilization. Now, when we ask for more credit card funding, easy approvals. So this is the second thing we want to know. The third thing we want to know is credit mix. A lot of people don't understand this, but banks actually prefer somebody that has a mix of different types of accounts. So you have revolving accounts. Revolving, think of a circle, right? Revolving. There's credit cards and lines of credit. The reason they're revolving is because as you spend money, you have less to spend, but once you pay it back, you have more to spend. It's like a gas tank, right? As you fill the gas tank up, you have all this mileage, you drive around, you lose the miles, but then you fill up the gas tank again, and then your miles open back up. Same thing with lines of credit and credit cards. You have the full amount ready to spend. As you spend it, you have less available to spend. As you pay it back, you have that money back available. So that's revolving. Banks want to see us have some type of revolving accounts, but then they also want to see us have installment accounts. Installment accounts are going to be your loans. An easy way for you guys to think about this is think of the word install. They're going to install a monthly payment that's usually the same every single month. So the key difference here is usually on revolving accounts, you don't have a set monthly payment. It kind of varies depending on how much you spent for the month. So you could have 1 month a $500 payment, another month maybe a $300 payment, another month maybe only a $10 payment. Whereas installments, loans, usually you're gonna have the same monthly payment no matter what until the loan ends. So installment accounts, again, think of your loans. You got student loans, you got car loans, you got mortgages, those are your home loans, and then you got personal loans, etc. So the banks prefer somebody that has a revolving and installment account reporting at the same time. If you're somebody right now just starting your credit journey and you don't have any type of loan yet, for most people, their first type of loans are going to be student loans if they're going to college. And then for a lot of people, it's going to be their first car. Let's say you're somebody that doesn't plan on getting a student loan or doesn't plan on getting a car, then how else can you add a loan to your credit report? There's something called a pledge loan or a secured savings loan. Basically, these are products that are offered by credit unions. It's like a secured credit card. The only difference is that this is a loan version. So what you're going to do is you're going to open up a credit union account, call into the credit union to see if they even have these things available. It's either called a pledge loan or it's going to be called a savings secured loan. What you're going to do is you're going to give the bank your money. Let's say you give them $500. They're going to lock up that $500 and then they're going to give you back $500. And they're going to charge you a little bit of interest on that. But what happens now is your security deposit, which is your initial $500, they locked it up for themselves and then the bank gave you their $500 and now you're just making payments on this loan. This allows you to have an installment account start to report to your credit report. This allows you to start having a loan on your credit report, which helps you hit this installment account history. And then if you're also brand new to the credit game, you can get a secured credit card. This is where you give the bank your money, they lock it up, and then they give you a credit card with that amount as the credit limit. Now you're able to have these two things reflecting on your credit report. Now guys, secured products are mainly going to be for people that are just starting their credit journey or rebuilding their credit journey. If you're somebody that's more advanced, you don't really need these things unless you're somebody that's established and you don't plan on getting any more loans. Maybe you already got a couple cars in your past, you paid off all your student loans. Maybe you've just paid off a lot of your debt and you didn't know it was in your benefit to have a loan open. Then this is when a secured loan can make sense. So you can go to the bank, open up a secured loan, and then have them lend it to you back. And now you have a loan reporting to your credit report. So the biggest thing though, if you guys are going to go secured credit cards or secured loans, make sure the bank you are going to refunds you that money. When it comes to credit cards, usually if it's a secured credit card, after 6 to 12 months of responsible behavior, they will give you that money back. You need to confirm with the bank that they can do that, because what you don't want to do is you give them $5,000, let's say that's your security deposit, and then they have it for the rest of their life. The only way for you to get this money back is if you close the account, and we don't want to do that because when we close the account, we lose credit age. So for that reason, if you are going the secured credit card route, make sure you go with banks that literally tell you this card can become graduated or become unsecured after responsible use. Some of my favorites that do this is actually going to be Bank of America, is going to be Wells Fargo, and then you actually have Discover. These banks here let you know after 6 to 12 months of responsible use, they can refund you your security deposit. Now, when it comes to the pledge loans, with the pledge loans, same thing. We want to go with banks that as we pay them back, they release that money into our savings account. So usually what you don't want to do is give the bank, let's say $50,000 so you can have a loan reporting on your account. And now the only way to get this $50,000 is when you finish paying off the loan. You don't want to do that because now your money is tied up. What we want to do is go to banks where if you give them the $50,000 security deposit, as you make your monthly payments, they're actually releasing that money into your bank account. So every payment you make, you're literally getting that money right back. A bank that does this very well, which is why it's so hyped up, is actually Navy Federal. So Navy Federal, they have theirs called the pledge loans. And then you guys just want to check with other credit unions. A lot of credit unions call their product, the version of the pledge loan, they call it a secured savings loan. Navy Federal calls theirs the pledge loan. So guys, this is how we hit credit mix. After that, no negative items. Super simple. We don't have to go into detail here. If you got collections, repos, bankruptcies, charge-offs, I don't care if it's $5 that you owe to a collection company, get it deleted. Any negative items you have are going to make your credit report not ideal, and it's going to make you get denials. So seek credit repair if you have any type of negative items. After this, we got credit age. Ideally, we like to see at least 4 years of age or higher. The longer you have age, the better. If you can have 10 years, 15 years, 20 years, great, fantastic. The minimum we want to go for though is at least 4 years of age. So what do you do if you're somebody that's brand new? Maybe you're 18 and watching my video. Shout out to you, you're getting yourself educated. But maybe you're 18, you literally just opened your first credit card and you have 2 months of age. What now? Well, there's something called a trade line. Trade lines, let's go ahead and write that down. So trade lines are referred to as piggybacking and also as authorized users. This is also called AU, and then again, the piggybacking. So all these things is the same concept. What you are basically going to do is you're going to find somebody that has a credit card account that has been open for a long time and ideally has a big credit limit and also has a low balance. The reason why is because remember, credit utilization, credit age, and then payment history, all that is in the credit card account. If you ask somebody to add you onto their account and they had late payments, maybe their cards are maxed out, maybe it's a brand new card, that's gonna show up on your credit report and it's gonna mix in with your data and it's actually gonna bring your score down. So the reason we need to be very picky about who we're asking to add us onto their credit cards is because we are going to get all of their data onto ours. So what we want to do in order to maximize the age is ask somebody that has had a credit card open for a very long time. The longer the better, guys. For me, luckily, I have some friends that are a little bit older than me, so I got added onto some credit cards that have 10 years of age. I've been added onto some that I purchased that had 30 years of age. All this helps boost your age super quick. So what I would say, if you're trying to get to that 4-year mark, either ask friends and family first, because that's completely free and they keep you long-term on their credit cards. Ask them and then verify the account was open a long time ago, always has a low balance, has never had late payments, and has a big credit limit. That way it can help you out as well. But this is how we're gonna hit this 4+ years of age very, very quickly. We wanna get trade lines. If you don't have friends and family that can help you with a trade line, visit a website called Trade Line Genie or Trade Line Supply. Go ahead and do your research, but these are places where people buy trade lines from. Now, moving on to the next part, 5+ accounts. So one thing banks are looking for is they're looking for people that know how to manage multiple accounts. The reason why is because you look more responsible when you can handle various things compared to just one thing. I'm gonna give you an example. A lot of you guys may think credit score is everything, right? Well, you could have an 800 credit score with just one credit card. Reason why is because if you have this credit card long enough, you're gonna have a crazy amount of age. So you could be an 800 credit score person with just one credit card. But let's say you have person number 2. Let's say this is person number 1. Person number 2, let's say they got a 730, but they got 4 credit cards, and then they got 3 loans. This person looks like the lower candidate because they have a lower credit score, but they're way better than this person because this person has 4 credit cards they've shown they can handle. They also have 3 loans they've shown they can handle, while person number 1 only has 1 credit card. So yes, the credit score makes it look like this person's better, but in reality, the person that's handled more accounts is going to be the person in better position for approvals and higher limits when it comes to funding. So this is why we want to make sure that we have multiple accounts. We want to hit at least 5 minimum accounts reporting. That means open at any time on our credit report. And one other thing that we want to take note of, we don't want to just throw anything on the credit report. Nowadays, there's a bunch of credit builders. Everybody's telling you sign up for kickoff, sign up for this, sign up for that. Me personally, I do not like credit builders. The only credit builders that are good in my eyes are going to be the secured products that I mentioned, because these are going to be coming from actual banks and big institutions. When you get little credit builders like a kickoff or a Pava or stuff like that, banks don't really care about those because yes, it does build somewhat of your credit, but a lot of times that's not an actual bank. They know it's just a small paid service. They know it's not as reliable as you actually paying back a big bank. So this is why I actually don't recommend credit builders to my students, to any of my clients. One other thing I've been seeing as of recently, some banks are starting to deny people because they have credit builders on their accounts. So there was a bank, I'm not gonna say its name, but there was a certain bank we applied to, client had a great credit file, but they actually got denied. And I was surprised. Once we look at the denial reasons, we saw that it said credit builder on account. So this is now showing you guys that credit builders can actually harm you. And I'm gonna assume the reason why is because a lot of people that go through credit repair, as they're put on credit repair, people tell them to also sign up for these credit builders. And being real with you, a lot of people tell you to sign up on credit builders because you usually get an affiliate commission. So that means if you're getting signed up to a credit builder, maybe you're paying $10, but the person that referred you is getting 3 of those $10. So they make a little bit more money. That's why credit builders sometimes are pushed out a lot. Me personally, I don't think they're good for you. And again, I'm now starting to see banks deny people that have them. So that's why I don't recommend them. And to bring it back, because I went off track, the reason why I'm assuming people are getting denied now that have credit builders is because a lot of people that go through credit repair get put on the credit builders. So now what it's telling us is that usually people that have credit builders on their accounts might have gone through the credit repair process. That's what I'm assuming is happening. Because obviously guys, banks, they're not dumb. They catch on to things. They see the trends. They know exactly what's happening. They're watching videos just like this. So I'm assuming the reason why I'm starting to see people getting denied that have credit builders on their credit report are because banks are aware most people that have those go through credit repair, which means if they've gone through credit repair, they have a bad history. The whole point of credit repair is to delete your history so no one can find out about it. But now it's starting to seem as if you have a credit builder, you most likely went through some type of credit repair. So again, I don't recommend it. If you want to keep having them, totally up to you. But if you do want a reliable credit builder, I'm talking a secured product, a secured credit card from a bank that graduates, or a secured loan from a bank that gives you your money back, not these credit builders that you pay every single month for it to report. The final thing, when we're adding these things, we want to have tier 1 through 3 banks. Tier 1 through 3 banks, what does that mean? We want to show on our credit report that we're with the big dogs, that we're in the big leagues. Tier 1 banks are the best banks to have on your credit report. That's Chase, Wells Fargo, Bank of America, and Citibank. Then we have tier 2 banks. Tier 2 banks is going to be US Bank, American Express, and then your regional banks. These are still big banks that operate in certain regions of the United States. And then tier 3 is going to be your credit unions. And then you actually have tier 4, which is subprime banks, banks you don't want to be with. This is going to be your store cards and other lenders. What I would prefer you guys to do, if you need to build credit because you're restarting or you're brand new, get a secured card from these tier 1 to 2 banks. And then if you're not somebody that's building right now, maybe you already have established credit, you just want to add more accounts, take out some cards from the big banks. But we want to have at least 5 accounts open at any time. And I would ideally want at least 2 of your accounts to be from tier 1 banks. And if you're just starting, focus on making all of them tier 1, tier 2, tier 3 banks. Now, finally, the last part, hard inquiries. Anytime you ask the bank for money, they're going to put a hard inquiry on your credit report, pretty much letting everybody know you just asked for money, that you just asked for credit. These hard inquiries will lower your score, but they remove on their own every 2 years. So they self-delete. So if you get a hard inquiry today, 2 years from now, it's gone. So don't worry too much about hard inquiries. However, you do want to be strategic. When you're getting ready for funding, don't just apply randomly and throughout the years. Make sure you time everything so when you go for a round of funding, you can hit a couple applications on Experian, a couple applications on TransUnion, and a couple applications on Equifax. This is called building a proper funding sequence. If you guys don't know how to build a funding sequence or what a funding sequence is, I have a video that explains that. Just look through my videos, search in funding sequence, and you'll find it. But pretty much when we're going to ask the banks for money, we want to have as little hard inquiries as possible. So if you can get them deleted through credit repair, great. Delete the ones that you can delete. And if you already have some hard inquiries right now, don't worry. After about 12 months, they don't really impact you. If you're in a rush to get some funding, wait at least 6 months. That's usually a spot where we see they don't have too much of an impact, but to be completely safe, wait at least 12 months, and even better, wait until they're deleted, which is 2 years. So guys, this is everything about how a strong credit profile looks like. I hope you guys got a lot of value. We broke down a lot of topics. A lot of these topics, I've actually made the own video about it. So if you guys are interested in learning more about any of these sections, go ahead and search it up in my channel. But other than that, if you guys are new, I hope you guys enjoyed this video. Make sure to hit the subscribe button so you're notified anytime I make a new video. If you're returning, I hope you liked this video. And if you guys did, go ahead and put a comment down below of what you thought, what you learned, anything you want me to cover for the next class, for the next video. Hit the like button, and I'll see you guys here for the next one. See ya.